The federal government looks to overhaul the $3.3 trillion superannuation industry. There are signs, tentative signs, that house prices in some cities might not go much lower. And Facebook introduces a subscription service. It's Tuesday, the 21st of February, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, your interview today is an interesting one. You're speaking with Matt Nunn, the founder of Nunn Media.
Yes, we talk about whether or not the slowdown in consumer confidence, but not business confidence, but consumer confidence, has affected the advertising market, whether retailers, people like that, car companies are still spending money on advertising, where they're spending it, and why they're spending it in those areas. A really interesting chat about the world of advertising.
Yeah, it's a good one. It's coming up a little bit later on, but the main story this morning, Sean, is a big one. The federal government is pushing for an overhaul of how superannuation funds are invested, saying it should be better used for nation-building projects.
Michael, a $3.3 trillion pot of money, that's what super's worth, is much too tempting for the politicians to ignore. Treasurer Jim Chalmers yesterday said the super system should focus on providing dignified retirement income in an equitable and sustainable way. Under the government's proposal, the objective of superannuation would be legislatively enshrined to achieve those goals. Equity and sustainability, they're the two important words in this. Effectively, the proposed legislation, which is open for consultation, will help investment by funds in projects that boost housing supply, manage climate change and spur digital transformation. The Treasurer also hinted that he may use the reforms to crack down on the generous tax breaks for owners of large super accounts.
So, okay, what you're saying, it does all sound good, but doesn't it kind of come down to financial returns versus returns for the good of society?
Yes. Look, there are plenty of studies around that say looking after the environment, society and good governance, that's ESG, if you do that well, you're going to get better financial returns. Plenty of studies that say that. But it's not a lay-down misere. I mean, anyone who invested coal companies last year, not exactly environmentally friendly, probably did better than people who invested in clean energy. So it's not a simple equation. Plenty of fund trustees point out that their duty is financial returns, not social returns. And that's true. If you do believe social returns are important, many fund managers already have options for that. Now, Chalmers yesterday said sustainable investing can offer similar returns to members as less socially conscious expenditure. That's his line. What critics are worried about is that the government is talking about taking away some choice in super. And remember, superannuation is your money, my money. It's not the government's money.
Yeah, of course. And Sean, not all sustainable investing is the same. There are kind of degrees of it, right?
Yes, good point. I mean, there's something called the green curve out there around sustainable investing. It sort of starts at one end when someone makes an investment and just considers these ESG factors. It goes through to things like screening out certain products, i.e. I'll never invest in a tobacco company or a gaming company or something like that, through to the other end of the curve, which is all about investing in products that have a genuine benefit to society. Social housing is an example on that. It's a very complicated world when it comes to sustainable investing. We clearly need to know much more detail around what the government is getting at. And already there's been all sorts of commentary and outcries from people saying the government needs to get its hands off our super. We'll be talking about this one for a while, Michael.
Yeah, it's a very big, very important conversation. Sean, how did the local market perform yesterday?
The S&P ASX 200 closed up just a touch to 7,352 points. Final result really doesn't tell the tale though, because there was plenty of movement in stock prices, particularly among the large caps. BHP and Rio Tinto both jumped around 1%. Fortescue Metals was up 1.6%. Banks had a pretty good day out. National Australia Bank rose 1.6%. Commonwealth and Westpac rose more than 1%. Macquarie Group was up almost that amount. QB Insurance, which of course reported last Friday, finished 3.5% high yesterday. And a little interesting fact, of the largest 25 companies on the ASX, QBE is the best performer over the past year. There you go. Wesfarmers didn't do so well, falling back nearly 1.5%. Energy groups Woodside and Santos and diversified miner South32 all underperformed as well. Best on the day was Ingham's. Remember, we talked all about that yesterday. Basically, they've told us the price of chickens are rising. Investors like that story. It finished the day up 11%. Michael, earnings season is almost halfway through, and investment bank Barrenjoey yesterday said that out of the 91 top 200 companies to have reported financial results so far, 40% have beaten earnings per share forecasts versus about 31% that have missed.
Sean, I was just about to embarrass myself horrendously and try and work out then what the remainder was that must have come in pretty much as expected, and I still haven't been able to do it in my head.
Oh, you mean the maths of it, the 29%?
Yeah, 29%. Yep. Yeah. Oh, goodness me. All right, we're going to move on from this one very quickly. But actually, while we're on the topic of earnings, there were plenty of results out and about yesterday.
Yeah, I mean, there are dozens coming out every day at the moment. Some of the bigger ones, health insurer NIB Holdings said the trend toward private cover after the pandemic continues, and earnings last half hit a record level, but profit margins look to have peaked, and investors sold the company down. Its share price fell nearly 12% yesterday, the worst of the top 200. New Zealand-based A2 Milk Company posted a 20% plus profit rise last half year as it grew share in the all-important Chinese market, but investors sold the stock down. It ended off nearly 9%. Bendigo Bank had a pretty good net profit, but it warned that ultra-competitive behaviour in the lending market was hurting. Its share price rose 2%. And finally, gold miner Northern Star Resources reported a 3% increase in half-year cash earnings, but its share price was down 1.5%.
And what about international markets?
Well, Wall Street was closed overnight for the President's Day holiday. Now, Michael, President's Day is officially called Washington's birthday. And the idea is that people get a day off to honour all those that have served as president of the US, particularly George Washington and Abraham Lincoln, but more generally, anyone who's ever been a president. I just don't reckon we're going to get a Prime Minister Day up in Australia.
Do I sense the beginning of a very, very unpopular fear and greed campaign here, Sean, to introduce Prime Minister's Day?
PM Day in Australia. Yes, what a great idea, don't you think?
I can really see that one catching on, Sean. I think it's a great idea.
Yeah. Otherwise, not a lot of movement in commodity markets. You know, when the US is closed, everything seems to slow down a bit. The Aussie dollar is buying just under 69 US cents.
All right, we'll be back in a moment with the rest of the day's business news. Sean, is it possible that the housing market might be finding a bottom? Real estate agent John McGrath certainly thinks so, and CoreLogic figures for the weekend show pretty high clearance rates.
Now, I don't want to be grasping at straws here, but I do live in hope. Of course, it probably isn't a surprise to hear a real estate agent talking up the housing market, let's face it.
Not particularly, no.
But McGrath runs his ASX-listed company, so he can't be too over the top. John McGrath is a very experienced agent, so I think he's unlikely to be too off point. Yesterday, he forecast that house prices are beginning to stabilise and will rise again next year. He was commenting after outlining a big drop in half-year profit for his company on the back of fewer sales last year as the downturn hit. Now, over the weekend, the Sydney clearance rate hit 78%. Remember, late last year, it was 58%. Obviously, there are less houses on the market. That helps. But the withdrawal rate of houses from auction is lower, and 78% is very high no matter what. CoreLogic's Tim Lawless says that there is a stabilising trend on CoreLogic's daily home index for Sydney. In Melbourne, the clearance rate was back up to 68%, while nationally it was nearly 71%. All that is good news, but I'm going to give the last word to AMP's Shane Oliver, just so that we can't be accused of trying to talk up the market. Shane has very different views. Basically, he said maybe the return of immigration recently and fear of missing out is helping out, but he doesn't reckon there's a turning point yet, and house prices still have a way to fall.
All right, well, we shall wait and see. Sean, Ampol has posted a record annual pre-tax profit up nearly 250% and will issue a bumper dividend to shareholders.
Yes, excellent news for shareholders. But what about those of us paying more than $2 a litre for petrol?
Don't forget the diesel users here, Sean.
And the diesel users. That's right. Now, I've got to say, I don't understand the economics of petrol prices. I've tried. It's beyond me. Anyway, look, oil refining, which is what Ampol does, a couple of years ago, it was pretty much worthless. In fact, it was so poor that the government underwrote the sector on the basis of national security. Now it's a booming business, and that's underpinned Ampol's incredible result that was announced yesterday. The recovery in global demand and sanctions on Russia have also contributed, indirectly at least, to the bottom line. Now, Ampol is the country's largest provider of petrol, diesel, and aviation fuel. Its share price ended the day up 2%. It didn't say anything about petrol prices, though.
Sean, when the government and this is a question without notice, and I have no idea how you'll go with this one. When the government underwrote the sector, and now that it is booming, did they receive any kind of return on that investment, or was it just basically a safety net?
It's a safety net. So depending on, it's all about margins. And so when margins fall below a certain point, the government steps in and tops up the margins. Margins are far, far above that particular point at the moment. And so Ampol's making a lot of money, but it's not repaying, if that's your point, it's not repaying the money that it may have taken from government previously.
Wow. That was superb. I wish I had an applause soundtrack now. Just that was a fantastic answer to a question that you did not know was coming. So I learnt something, Sean. Now, moving on, the Commonwealth Bank is targeting $1 billion in invoice financing as it returns to the sector as part of a bid to compete with the market leader, National Australia Bank, in business lending.
Yeah, business lending is particularly profitable. It's nowhere near as competitive as home lending. So Commonwealth Bank has it's spent about $600 million over the past 3 years to get into business banking. The broader strategy includes accelerating referrals from Commonwealth Bank's dominant retail arm and extending new payment services, including its Powerboard platform, according to a report in the Financial Review. Commonwealth Bank wants to diversify away from retail mortgages. Growth's much harder there than it is in the business area. Commonwealth Bank has the highest market share in payments terminals and business transaction accounts, but National Australia Bank is the largest lender. It's got about $288 billion in loans to business customers, and Commonwealth Bank's got about $254 billion.
Sean, steel giant BlueScope's share price tumbled nearly 10% yesterday after boss Mark Vassella said customers are cutting back on orders as the economy slows.
The weaker than expected outlook was enough to send BlueScope's share price tumbling, and it's clear that the peak of this steel cycle has now passed. Now, Vassella's outlook statement was much more pessimistic than the actual result, of course. Now, steel products, things like, ColourBond steel, housing frames and that, there's longish lead times. Hence, there's always going to be a difference between what's happening now, or in fact, the last 6 months, and the future outlook. What is clear is that those glory days of COVID pandemic, in terms of steel, at least 2020 and 2021, are definitely over. Back then, everyone seemed to be building or renovating or doing something at home. Earnings for the December 6 months for BlueScope were down 63%, reflecting that change. And just as an aside, Michael, BlueScope's among the country's biggest carbon emitters, and Vassella said the company wants to see details of the government's trade mechanism for carbon credits before making too many big investment decisions.
How about this one, Sean? Last week, we talked about Andrew Forrest's stoush with fellow WA billionaire Kerry Stokes around what the latter's media empire does. Mr. Forrest is also battling another WA billionaire, can you believe it, Chris Ellison, about a road next to his family home.
Yes, and yesterday Forrest lost a battle in that particular war after the Western Australia environment regulators gave conditional approval for a new iron ore haul road to be built next to a Forrest family pastoral property. Now, Mr. Ellison's Mineral Resources wants to build a 125-kilometre road to connect the Ashburton port with a nascent mining hub in the West Pilbara. The plan's been opposed by Dr. Forrest's privately held pastoral company because the road will run past the Minderoo Station property that has been owned by the Forrest family for most of the past 145 years. Yesterday, Ellison got the win, but I tell you what, these billionaire stoushes in WA, there's plenty of them.
Well, I described it last week as a very niche fight club, but it's becoming less niche, isn't it? Feels like everyone's a billionaire battling today. This is just amazing. International news, Sean, there's a bit going on. Facebook parent company Meta Platforms is launching a subscription service called Meta Verified that will include additional perks and features, including account verification badges for those who pay.
According to Bloomberg, the new subscription will cost $12 or just under $12 per month and is targeted towards content creators. In addition to a verification badge, the subscription includes proactive account protection, access to account support, and increased visibility and reach, Meta says in a statement. Now, the option will be available on both Facebook and Instagram, but they'll be separate subscriptions, so you can't just pay one and get two. You've got to pay twice. It just follows a trend in that whole big tech sector. Subscription offerings have become popular for social networking companies in recent years. Basically, it's a way to diversify revenue. At the moment, they're heavily reliant on advertising, and looking beyond that, Snap has an offering called Snapchat Plus. Twitter's also pushing a subscription offering right now. In that instance, account verification is a major selling point. Clearly, that's where they think there's value to consumers.
Yeah, I really don't understand this one, Sean, because account verification shouldn't be something that's able to be bought necessarily. The whole idea of it is to verify who you are following or who you're speaking to is actually who they say they are. And if you can actually purchase that for $11.99, you would feel it seems like it actually diminishes the value of it.
Yes, that's a very good point. I haven't thought much about that, but you're totally correct. If you've got to purchase verification, what's that mean for the rest of us who don't pay the subscription fee?
Absolutely, indeed. All right, now this one's pretty serious, Sean. The boss of Chinese investment bank China Renaissance has disappeared, triggering fears of what exactly happened and might happen to bankers in China.
Bao Fan is the company's well-known founder. He's also the largest shareholder. But last week, the bank announced he'd disappeared. Now its share price tumbled as a result. The fate of Bao and his company, which has for years been at the heart of financing Chinese technology companies, is a total mystery. And commentators are saying it's a pivotal test of Beijing's stance on the industry, according to the Financial Times. A 2-year government crackdown has already sidelined people like Alibaba's chief Jack Ma. It's really hit the vast for-profit education industry hard. Investing has suffered as a result. There are fears that when high-profile bankers disappear, whatever that means, that may spread to other bankers, and obviously that is a concern.
And finally, Sean, how's this for possibly the ultimate flying nightmare, which I suppose is saying a lot because I can imagine some pretty horrific things happening on a plane. In September last year, Air New Zealand started flying direct to New York. On Thursday last week, flight NZ2 was on the way east and almost at Hawaii when it turned around and flew back to Auckland.
Effectively, it was a 16-hour flight to nowhere. That is pretty bad for it, wouldn't you say?
Oh, you know what? I could make a list of things that I think would be worse than that. And most of them start with turbulence and crashing.
Right. Well, crashing, yeah, I'll give you that. Look, the flight was due to land at JFK International Airport, but that facility experienced a power outage at Terminal 1. Now, about 135 flights were affected, including the Air New Zealand Boeing 787 jet. It was almost halfway into its 14,000-kilometre journey. So it was diverted back to New Zealand.
So there was nowhere closer.
Hawaii, Los Angeles, surely.
Well, we've learned from this story, Sean, that you and I have very different definitions of what a flying nightmare is.
Yes.
Yours is being stuck on a plane
for 16 hours and yours is crashing.
Yeah, that's right. I suspect most people would side with me. Now, up next is the Fear and Greed Daily Interview. You're speaking with Matt Nunn, the founder of Nunn Media.
Yep, all about what the big brands are doing re-advertising, where they're advertising. We talk about free-to-air, we talk about digital, radio, even podcasts, Michael. Fascinating chat.
Yeah, it really is. It's a good conversation. It's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Tuesday, the 21st of February, 2023. Make sure you're following the podcast and join us online on LinkedIn, on Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.